John, those of us in business and financial news like to think that we're providing information and helping people make better decisions with investments. But I wonder if sometimes we might skew the system a bit. We tend to cover the really big ones. You know, when somebody goes over $1 trillion in market cap, boy, they get a lot of attention. Some people have balloons coming down and things. But talk to us about large versus small, because I think you have a somewhat different view about this.
Well, from the very beginning, when we started Ariel 38 years ago, we were heavily influenced by the place that I used to work, William Blair. You know, Mr. Blair used to always talk about the fact that smaller companies should be able to grow faster than larger companies. And we still believe that today. They can be more nimble. They can be able to take advantages of market opportunities when you're small and nimble. But secondly, smaller companies are less well-researched. They were less well-researched 40 years ago, and they're still less well-researched. They're not as well-followed. So you can find some inefficiencies in the small cap sector. And even today, the amount of research in the small cap sector, as you suggest, have gotten less and less and less. People are just not following these sort of neglected companies the way they follow the large growth companies that have been so popular, that are the multi-trillion-dollar companies. So you can do your own homework, do thorough research, and find these undiscovered gems, we think, in that small cap sector today more than ever. And that's why we continue to fish in that same fishing pond.
Do you have to be particularly diligent in that research on the debt structure? Because certainly I've seen reports that you have more zombie companies, people who don't generate enough cash to actually service their debt in the smaller cap companies. Is that true in your experience, and how do you avoid that?
There are a lot of frauds out there. There are a lot of companies that are hyped and have just great stories, but when you look behind the scenes, you know, the reality is not real. So one of the things we learned through the financial crisis is that we needed to create our own proprietary debt ratings. And Charlie Bobrinskoy, our vice chairman, heads up that effort, and making sure that we're not dependent on Moody's or S&P or any outside services. We're going to do that homework ourselves to make sure that company has the strong balance sheet to be able to withstand whatever things happen in our economy. But you have to be extra vigilant when you're working in these small companies, because they are susceptible to frauds and company managements that sometimes are telling a story that simply isn't true. So that's another reason why it's so important to visit with management teams, get on the plane, go and see people. During COVID, get on the Zooms and look people in the eye. Finally, we use a company called BIA Associates to help us ask better questions and help us to determine whether CEOs are answering honestly and ethically. We study their body language, we study the way they answer those questions, and we think it's just so important to be kind of an investigative reporter as we meet with these management teams to make sure we're getting the best information in the best way possible.